Hi everyone and welcome to Pandora. Today we will try to answer to the following question. Is Pandora interesting to buy right now for a value investor? But first, what is Pandora? Pandora is a Danish jewelry company listed on the Nasdaq Copenhagen exchange and founded in 1982. They design, manufacture and sell and finish jewelry worldwide, with a reputation built on customizable charm bracelet, rings, earrings, necklaces, and lab-grown diamond collections. They are geographically well diversified, operating in more than 100 countries. How are they making money? Pandora operates a vertically integrated business model, meaning that they control each key stage, from design and manufacturing in Thailand to sales and global marketing via concept stores, e-commerce and wholesale channels. Digital sales, for example, accounts for more than 25% of total revenues, thanks to features such as virtual try-ons and click and collect. Their revenues are coming from a bunch of diversified jewelries, such as rings, earrings, necklaces, and so on. Charm bracelets and individual charms drive core revenue. Pandora sold over 100 million items in 2024, averaging 3 pieces per second, which is completely amazing. Now, let's look at some metrics. We can see a return on invested capital of 35% and a gross profit margin of around 80%, driven by their vertically integrated business model. Their operating cash flow and free cash flow margins stand at approximately 25 and 20% respectively. Truly impressive figures. Regarding their capital structure, we can see that the debt appears relatively high as a comparison with equity, meaning that the company relies more on debt financing than on equity. However, the debt level remains manageable as it only represents the equivalent of 2 years worth of operating cash flow. As we can see, the revenues, operating income, and net income have steadily increased over time on the past 5 years, reflecting Pandora's strong and consistent growth trajectory. Now, let's focus on Q2 2025. The first positive takeaway during this quarter is that the company reached a growth of 8%. However, on the downside, both gross margin and EBIT margin declined by 0.9% and 1.6% respectively. From the cash flow perspective, we can see that the operating profit declined. It was mainly due to the decrease in gross profit margin and EBIT margin. This effect was further amplified by an increase in inventories and higher interest costs. Overall, these factors had a negative impact on the operating cash flow margin, which dropped to 19.6% compared to 24% in Q2 last year. However, there were also positive signs during this quarter, with Fuel with More segment, which showed a really solid and promising growth, mainly driven by Pandora eSense. Moreover, during Q2 2025, the gross margin for this segment, Fuel with More, reached 82%, outperforming the core segment, which posted a gross margin of 78%. However, the market reacted negatively to these quarterly results. Personally, I had expected slightly higher profit margin and lower capex, but I was still somewhat surprised by the strength of the market's reaction. Let's now take a look at what management shared during an interview regarding these results.
You reported second quarter earnings and your stock tumbled after your revenue missed analyst estimates. What surprised you about the current backdrop?
So we delivered 8% organic growth. We delivered 3% like-for-like. We had an 8% like-for-like growth in the US. So I have to say I'm quite surprised by this big reaction from the market. I mean, we were hair off. We reconfirmed the guidance for the year. We reconfirmed the profitability of the group. So actually, Pandora is in a really good shape. So the reaction from the market, I think, is quite volatile, actually.
As other remarks, I would like to emphasize the fact that Pandora is the world's largest jewelry brand, with a vertically integrated business model. They allow their clients to customize their jewelry, which creates a strong emotional bond. They focus on a sustainable strategy, switching entirely to recycled gold and silver and lab-grown diamonds, which reduce the impact on the environment and allow them to better control their supply chain. Lab-grown diamonds are impossible to detect with the naked eye. Even professionals need specific equipment to be able to detect growth-related fissures. And of course, it's less expensive to produce. Pandora operates in more than 100 countries, owning some of their stores and e-commerce websites. With such a big network and with all these factors, it's undeniable that Pandora has a strong competitive moat, and it will be really challenging for competitors to take their crown. Identifying significant risks for Pandora is challenging, as in my opinion, most of them are minor. Like any business, competition is a factor, with names such as Swarovski and other jewelry brands. However, as we discussed earlier, Pandora maintains a strong competitive advantage. A more notable area of concern involves tariffs and taxes. In particular, the new US tariffs on goods imported from Thailand, currently at 19%, could have a negative impact on profitability. Management estimated an impact of 200 million crown for this year and more than double that amount next year. That said, Pandora is already implementing mitigation strategies such as price adjustments, cost optimization, and supply chain diversification to offset these pressures. Finally, let's talk about valuation. As we can see, the current stock price is lower than both the DCF and the DCF without growth. However, looking at the assumptions used to compute the DCF value, we see that the capex margin is set to 4%, while it's expected to be higher this year, around 7%, due to investments in the store network, e-commerce initiatives, and a new manufacturing facility in Vietnam. These investments, however, are not expected to continue and are projected to either drive better profitability margins or to support revenue growth over time. Overall, I personally think that the current stock price is undervalued, taking into account the profitability and the competitive advantage of Pandora, and AI has come to the same conclusion. Then, is it time to invest in Pandora? Only time will tell.